Today, peering through the smoke, a market update for the 11th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Wall Street ended sharply lower on Friday as investors weighed signs of higher inflation, while Apple tumbled following an unfavorable court ruling relating to its App Store. There is a sense of pessimism throughout equity markets, says Lewis Grant, Senior Global Equities Portfolio Manager for Federated Hermes, a fund manager. In recent days, the rally has seemed to lose momentum and falter, with indices retreating from historic highs. With peak everything, a deceleration is looming. US shares in particular appear primed for a pullback, according to Morgan Stanley, which predicts a so-called correction, a decline of 10% from a peak, to take hold in coming months. At the close in New York, the Dow Jones lost 0.78% to hit a new one-month low and close at 34,607, while the S&P 500 index fell 0.77% and the Nasdaq Composite lost 0.87%. For the week, the S&P 500 lost 1.7%, the Dow declined 2.15%, and the Nasdaq shed 1.61%. Friday was the first time since February that the S&P 500 declined 5 days in a row. But remember, the S&P 500 has risen by 19% in 2021, buoyed by support from dovish central bank policies and reopening optimism. US equities have been whipsawed amid mixed economic data and a lack of clarity on the Fed's timeline for reducing its asset purchases. Investors have been assessing rising COVID cases, slowing growth, elevated levels of inflation and uncertainty over when the Fed could start tapering, said Fiona Cincotta, Senior Financial Market Analyst at City Index. The data has been mixed and the messages from the Fed have been mixed, leaving little clarity for the markets, which traditionally struggle with uncertainty. The economic data remains mixed indeed, with US producer prices up solidly in August, leading to the biggest annual gain in nearly 11 years and indicating that high inflation was likely to persist as the pandemic pressures supply chains. Sentiment also took a hit from Cleveland Federal Reserve Bank President Loretta Mester's comments that she would still like the central bank to begin tapering asset purchases this year despite the weak August jobs report. The three main US indices did get some support early from news of a phone call between US President Joe Biden and the Chinese leader. That was taken as a positive sign, which could bring a thaw in ties between the world's two most important trading partners. US-listed Didi Global dropped 5% after Chinese government officials told leading delivery and ride-hailing companies to improve how they distributed incomes and to ensure that there were rest periods for workers. On the data front, a Thursday release showed that Americans filed a total of 311,000 initial jobless claims throughout the week. The number was lower than both the 335,000 in the forecast and the 345,000 claimed last week. And a new survey found a majority of economists are expecting that the Federal Reserve will begin raising interest rates sometime next year to combat inflation. Maybe, but the 10-year Treasury yield's recent trend still reflects a flat to downside bias. The main source of uncertainty, of course, remains the Delta variant of the coronavirus, which has created headwinds for the economy and the labour market specifically. This was clear in the August employment report from the Bureau of Labour Statistics, said Mark Zandi, chief economist of Moody Analytics. After adding close to 1 million jobs in both June and July, businesses added fewer than 250,000 jobs last month. That's not bad in typical times, but not good when the economy is still down over 5 million jobs from before the pandemic. In sum, he observes, that the dramatic come down in job growth was driven by businesses that either closed or lost sales due to the virus. Unfortunately, the virus will remain a significant risk factor for the near term. The end game is to suppress the virus. Right now, we're still in pandemic mode because we have 160,000 new infections a day. That's not even modestly good control, which means it's a public health threat. Dr. Anthony Fauci, director of the National Institute of Allergy and Infectious Diseases, said in an interview on Thursday, in a country of our size, you can't be hanging around and having 100,000 infections a day. You've got to get well below 10,000 before you start feeling comfortable. So Wall Street is moving sideways now as investors digest indications of increased inflation and concerns about the Delta variant's impact on the economic recovery. Investors are also uncertain about when the Federal Reserve may begin reducing massive measures enacted last year to shield the economy from the pandemic. The market is taking a breather, said Greg Busick, CEO of AXS Investments. Investors are looking for some outsized news or information that is beyond the band of expectations, something much more outsized, positively or negatively, that will give investors better visibility into how things are going to look for the balance of the year. Apple dropped 3.3% after a judge struck down a core part of its App Store rules, benefiting app makers. Its drop contributed more than any other stocks to the Nasdaq and S&P 500 declines. The volatility index was up 11.44% to 2095. Crude oil for delivery in October rose 2.11% to 69.58. The euro-US dollar was down 0.1% to 1.1812, while the US dollar index futures was up 0.16% to 92.63. Gold futures for December delivery were down 0.61% or $11 to $1,789. In fact, gold booked its first weekly loss in 5 as a brief euphoria for longs over the dismal US jobs report for August gave way to dismay as the dollar rebounded on relentless talk of a Federal Reserve stimulus taper. The pain is even more acute in smaller stocks. 9 of the 10 companies in the Russell 2000 benchmark of small caps has fallen at least 10% since May, while just over half have declined by a fifth. In London, the UK's FTSE climbed 0.07% to 7,029. Sterling bucked a 3-day downtrend to end the day higher against the greenback. Unfortunately, the recent decline in manufacturing PMI tips the scale lower, though, for these reports. But gains are likely to be limited after the latest gross domestic product release showed the country grew just 0.1% on the month in July, a sharp drop from the 1% growth the previous month. The month was marked by the so-called pandemic that forced thousands of workers to self-isolate for lengthy periods. The figures left output 2.1% below the level in February 2020 before the pandemic struck. GDP was lower than the 0.6% growth forecast by city economists and a sharp slowdown compared with June when the economy grew by 1%. Service sector activity, which accounts for 80% of the economy, recorded no growth at all on the month, while the return of music festivals and sports offset by a sharp drop in high street spending and the decline in the legal sector linked to the end of the stamp duty holiday. Rising costs and shortages of raw materials triggered a fall in construction, while manufacturing remained broadly flat as firms struggled to fill staff vacancies in July amid a lack of suitable applicants and a reduced number of EU workers. The figures came as business leaders sounded the alarm over the economic recovery as a shortage of workers and materials fuels the worst supply chain meltdown since the 1970s, threatening to delay the UK's economic recovery from COVID-19. Ashpesh Pilche, a lead economist at the CBI lobby group, said temporary targeted interventions from the government were needed to enable businesses to keep their doors open, including relaxing post-Brexit migration rules to help companies hire workers. And Bridget Phillipson, the Shadow Chief Secretary of the Treasury, said the government's complacency was holding the country back. The concerning figures today show that just as the UK economy ought to be getting back to normal, disruption to supply chains and other shortages means our recovery is hitting the brakes, she said. The government has no plan other than to plough ahead with a tax on jobs, as well as a devastating cut to universal credit, taking money out of our high street just when it's most needed. According to the latest snapshot, the UK economy remains 2.1% below its pre-pandemic level, and overall GDP grew by 3.6% in the 3 months to July, as the easing of lockdowns enabled consumers to return to high street shops and boosted spending in pubs, hotels and restaurants. There was notably strong growth of 118% in air transport in July, as the easing of travel restrictions enabled more consumers to take foreign holidays, but the sharp rise was from a low base, while output in the sector remains 77% below pre-COVID levels. In fact, the main contributor to growth came from the reopening of an oil field after a planned maintenance period, helping to boost output in the production sector of the economy, which includes manufacturing, energy supply, mining and quarrying, by 1.2% in July. In Europe, the Stoxx 600 fell 0.3%, with telecommunications and utilities underperforming, while miners and technology companies led the gainers. The European equities benchmark posted a second weekly loss, the first time that's happened since the end of April, as investors reduced their risk on concern that central bank stimulus measures might get pulled back quickly. The European Central Bank delivered exactly what the market expected last Thursday. They slowed bond purchases and raised their inflation forecasts. Policymakers made it clear, though, that the change was, quote, a recalibration and not a taper, because the change was made to the Pandemic Purchase Programme, the PEPP, and not the Asset Purchase Programme, the APP. They also boosted their 2021 growth outlook, but shaved their 2022 GDP forecast by 0.1%. Initially, traders took the euro lower after the announcement, but the single currency managed to recover its losses to end the day unchanged against the greenback. Part of this can be attributed to the lack of surprise from the ECB, but investors also sold US dollars as Treasury yields declined. The most important takeaway from the ECB meeting was the central bank's optimism, although they went to lengths to downplay the move, with the ECB President Lagarde directly saying this lady isn't tapering and the current increase in inflation is expected to be largely temporary. The optimism was undeniable. She described the rebound phase of the economic recovery as increasingly advanced, and the economy is expected to return to its pre-pandemic size by the end of the year. This has led many investors to believe the ECB will confirm in December the end of the PEPP program in March 2022 as planned. A full recovery could be delayed by Delta, but the unanimous decision says a lot about the overall attitude in the central bank. The ECB announced a moderately lower pace of PEPP purchases as they work towards managing the envelope towards the programme's end then in March next year. The initial reaction was euro strength, but it soon gave back the move and turned lower. That was compounded as Lagarde emphasised transitory inflation and left hints that more APP buying could replace the PEPP if necessary. Still, there was good news for the Eurozone, as the 2021 GDP forecast was boosted to 5.1% from 4.6%, with the 2022 estimate left nearly unchanged. The forecast puts the economy back to a pre-pandemic level before the end of the year. In Asia, the MSCI Asia-Pacific ex-Japan Index eased further since Monday after a long slow decline from a peak in February that's wiped 10.8% from the index. The Nikkei 225 was up 1.25% to 30,381, while the Shanghai index was up 0.27% to 3,703, boosted by a rebound in Chinese gaming stocks, while news of a call between Chinese leader Xi Jinping and US President Joe Biden offered hope of better relations between the two economic superpowers. The Shanghai Composite Index climbed to a 6-year high. Crude prices traded higher on Friday, rebounding after the previous session's losses following the news that China sold crude from its strategic reserves via public auction. The move, believed to be a first, easing the pressure of rising raw material prices according to the country's National Food and Strategic Reserves Administration, and adds more uncertainty to a market struggling to cope with increasing COVID-19 cases. Still, US crude stockpiles fell last week by 1.5 million barrels, according to the Energy Information Administration, and almost 1.4 million barrels per day of offshore oil production remains shut in the Gulf of Mexico in the wake of Hurricane Ida. China's factory gate inflation hit a 13-year high in August, driven by roaring raw material prices despite Beijing's attempt to cool them, putting more pressure on manufacturers in the world's second largest economy. The producer price index, the PPI, rose 9.5% from a year earlier in August, according to the National Bureau of Statistics, faster than the 9% increase expected by a number of economists, and the 9% reported in July. That was the fastest pace since August 2008. China's economy has recovered strongly from last year's coronavirus slump, but has been losing steam recently due to domestic COVID-19 outbreaks, high raw material prices, tighter property curbs, and a campaign to reduce carbon emissions. Earnings at China's industrial firms have slowed for 5 straight months. Commodity prices have been on a tear in recent months, hurting the bottom line of many mid and downstream factories. China's coal prices soared to a record high on Tuesday over supply concerns as major coal regions started fresh rounds of safety checks. But iron ore prices continued to slip, with 62% fines down another 0.98% to 131.76. Indeed, coal and metal prices will likely drop back as construction activity falls amid restrictions on the property sector and slowing credit growth, Julian Evans-Pritchard, senior China economist at Capital Economics, wrote in a note. And the higher comparison base towards the end of last year will also pull down overall inflation. We doubt producer price inflation will rise much further, he said. The coal, chemicals and metals industries drove much of the price increases in August, according to a statement released alongside the data. Prices in the coal mining and washing sector grew 57.1% in August from a year earlier. And a separate MBS statement showed that the consumer price index, the CPI, rose 0.8% in August from a year earlier, compared with the 1% expected, and below the government target of around 3% this year. China tightened social restrictions to curb the Delta 19 variant, including travel limits, which have hampered service sector demand, although Beijing has largely contained the latest coronavirus outbreaks. Declines in airfares, travel, and hotel room prices due to the pandemic slowed consumer inflation on a monthly basis. Service sector activity plunged in August to the lowest level since the pandemic's first wave in April 2020, a recent survey showed, as COVID-19 restrictions threatened to derail the recovery. Many analysts expect the People's Bank of China to deliver a further cut to the amount of cash banks must hold as reserves later this year to lift growth, on top of the July cut, which released around 1 trillion yuan, or $155 billion in long-term liquidity into the economy. We expect monetary policy to remain prudent, with a slightly loosening bias for the rest of the year, said Jean Liu, senior economist for Greater China at HSBC, in the note. China's consumer price inflation, which is likely to stay muted, will not constrain a slight loosening stance, she added. The core consumer price index, which strips out volatile food and energy prices, stood at 1.2% on year versus a 1.3% rise in July. Yet, the costs of shipping continued higher, with the Drewry Composite Index at 1% or $97 this week, and also remains 309% higher than a year ago. The average composite index for the WCI assessed by Drewry for year to date is $6,695 per 40-foot container, which is $4,367 higher than the 5-year average of $2,327 per 40-foot container. Now, across Australia, there's a heavy sell-off that happened on Thursday, and that weighed heavily on the share market, which ended the week lower after a number of blue chip stocks fell. The S&P ASX 200 fell 116.3 or 1.5% to 7,406 this week, despite a 37-point rally or 0.5% advance on Friday. Following a slow start to the week, when markets rose only slightly, a weaker session on Wednesday and a heavy sell-off on Thursday pushed the market lower for the week. BHP Group led the losses on the market. As the price of iron ore drifted lower through the week, its shares fell 2.6% to $41.25. Rio Tinto was also weaker, shedding 4.6% to $106.22, while Fortescue Metal Group dropped 12.4% to $18.27. The major banks also dragged on the market. CBA dipped 0.7% to 101.09. Westpac slipped 1.4% to 25.65. ANZ slid 1% to 27.59, and NAB declined 0.9% to 28.45. Woolworths fell 2.6% to 39.66. Wesfarmers dropped 1.6% to 56.88. Goodman Group retreated 2.5% to 22.54, and Afterpay declined 3.3% to 126.46. Gold miners also were among the market's worst performers as demand for the precious metal weakened. Newcrest Mining slid 2.4%, $24. Northern Star Resources lost 6.4% to $9.14. Evolution Mining slipped 2.8% to $3.79. Regis Resources dipped 10% to $2.15. Westgold Resources declined 7.4% to $1.63, and St Barbara fell 7.4% to $1.45. Macquarie Group, though, led the market's gains, rising 3% to $174.23, hitting a record high this week. The group said it was on track to post another record profit after it revealed its interim earnings were likely to almost double. Alumina shares soared 9.3% to $2.18 as aluminium prices surged, hitting a 13-year high supported by supply concerns following a military coup in Guinea, one of the key providers of bauxite, the most common ore of aluminium, to China. And finally, as Christopher Joy noted this week, there is a regulatory contradiction that must be resolved where, on the one hand, the RBA guarantees the liquidity of government bonds and APRA says that they have zero risk of credit default loss, and yet, on the other hand, banks have to hold additional capital against these riskless securities to ensure against rare, unrealised mark-to-market losses on them. APRA announced that they expect locally incorporated ADIs subject to the liquidity coverage ratio, the LCR, to reduce their reliance on the committed liquidity facility, the CLF, to zero by the end of 2022, subject of course to financial market conditions. The LCR is a minimum requirement that aims to ensure ADIs maintain sufficient unencumbered, high-quality liquid assets, or HQLA, to survive a severe liquidity stress scenario lasting for 30 calendar days. The CLF, which was established with the Reserve Bank of Australia in 2015, is intended to be sufficient in size to compensate for the lack of sufficient HQLA, which in Australia consists of notes and coins, exchange settlement accounts, balances held at the RBA, Australian government securities, and semi-government securities. In a letter to applicable ADIs, APRA has advised that the use of the CLF should no longer be required beyond 2022 because APRA and the RBA expects that there will be sufficient HQLAs for ADIs to meet their LCR requirements without the need to utilise the CLF. APRA therefore expects ADIs to purchase the HQLA necessary to eliminate the need for the CLF, and specifically no ADI should rely on the CLF to meet its minimum 100% LCR requirement from the beginning of 2022, although ADIs may continue to count any remaining CLFs as part of that liquidity buffer. ADIs should then reduce their use of the CLF to zero by the end of 2022. And they went on to say that APRA will continue to review financial market conditions and will adjust these expectations should circumstances materially change. The CLF will remain available should it be needed to be reactivated to meet future shortfalls in the availability of HQLA. So this has effectively zeroed the massive taxpayer subsidy that was the $130 billion committed liquidity facility, which now will force banks to replace this existing portfolio of illiquid and relatively risky bank loans, bank bonds and residential mortgage-backed securities with much lower risk, and in fact riskless and more liquid Commonwealth and state government bonds. And it will also solve the problem of cross-leverage, where effectively banks were holding each other's bonds. This also has quite far-reaching and important investment ramifications for the fixed income markets, and for investors this is very good news for Commonwealth and state government bonds, which will benefit from a lower cost of capital and less positive for bank-issued Aussie dollar senior bonds and AAA rated residential mortgage-backed securities, which will have to undergo a normalisation in their credit spreads back to at least the levels observed prior to the COVID crisis. Yet, last July, the RBA announced a taper of its bond purchases from $5 billion to $4 billion each week, commencing in September, with a quarterly review. Media cited this as emulating the Bank of Canada's approach to QE, even though core inflation in Canada is running at 3%, well above its 2% target, whereas inflation in Australia is materially below the RBA's target. Following the RBA's July decision, the market assumed it would drop bond purchases by $1 billion per week each quarter. This implies total purchases for the RBA's third open-ended QE program, let's call that QE3, of about $105 billion, which was within the ballpark of economists' expectations. But Governor Philip Lowe recently stated that the RBA was prepared to increase or decrease the bond purchases in accordance with economic circumstances. And this week, the revised commitment in September to keep the RBA's bond purchase pace at $4 billion per week all the way through to February 2021 shows that Martin Place has increased the size of QE3 from $105 billion to $147 billion. This reflects the difference between the original proposal to cut the $4 billion per week bond purchases by $1 billion each quarter, so you could call that the 4-3-2-1 schedule, and the new plan of keeping the bond purchases consistent at $4 billion per week until February, following which they can be tapered according to the 4-4-3-2-1 schedule. And note that the $147 billion estimate for QE3 is now substantially larger than the $100 billion worth of purchases executed under the preceding QE1 and QE2 programs, which began in November 2020 and April 2021 respectively. This is even more weird considering government bonds are held by banks as a hold-to-maturity asset that would only ever be sold to the RBA in an emergency. And Joy says we should reasonably encourage rather than discourage banks from holding these assets in preference to competing deposits issued by the RBA that pays zero interest. But let's be clear here. The RBA is buying more government bonds than planned, and the banks are being forced to buy government bonds to replace the CLF. This is all about driving government borrowing rates down and nothing, frankly, about helping the real economy. Once again, the focus is on market manipulation, nothing more. As I always say, don't listen to what they say, but watch what they do. But QE remains alive and well in Australia and will remain so for some long time. That might be enough to stop equity markets locally from falling, that is, unless investors see through the smoke. But standing back, this week we had central bank decisions from the ECB, the BOC and the RBA, and they followed a pattern where the market largely tuned out. This could be a sign that at the forefront of trading are more global issues like inflation, problems with supply bottlenecks, labour shortages, and China's common prosperity push. Those global macro themes are likely to overwhelm central bank tweaks to their QE programs. And the point here, of course, is this, that markets will eventually wake up and see through the smoke, and when they do, markets will fall further. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.